The car market is starting to crack. At first, it does not look like a crash. It looks like small adjustments. A few extra incentives appearing on dealership windows. Inventory building quietly in the back of lots. Dealers offering limited time discounts again. The kind that disappeared entirely 2 years ago. But markets do not collapse all at once. They crack. And right now, the United States car market is showing its first visible fractures. Sales momentum is slowing. Loan stress is rising. Used prices are softening. And consumer confidence is thinning in ways that the headline numbers are not fully capturing yet. Today, we break down the data, the signals, and why these early cracks matter more than most people realize. Because once confidence goes, everything follows. And by the time it is obvious, the opportunity to act is already gone. To understand what is happening right now, you have to understand how we got here. Context is not optional. It is everything, is. Between 2020 and 2022, the automotive market experienced a supply shock that had no modern precedent. Factory shutdowns, semiconductor shortages, dealer inventory collapsed to historic lows. Vehicles that would normally sit on a lot for 60 days were gone in 48 hours, and buyers were paying above sticker without negotiation because there was simply nothing else available. Average transaction prices hit record highs. Used cars appreciated like investment assets. A 3-year-old pickup truck was selling for more than its original purchase price. That is not a healthy market. That is a distortion. And distortions do not correct gently. They reverse. The supply imbalance created the bubble. Now the reversal is beginning, and most consumers are not positioned for what comes next. The first fracture line is affordability, and it is not subtle anymore. The average monthly payment on a new vehicle has reached levels that are functionally unmanageable for a significant portion of the buying population. When you layer in the interest rate increases of the past 2 years, insurance premiums that have risen faster than inflation, and loan terms that have stretched to 72 and 84 months just to make the monthly number palatable, you are looking at a consumer base that has been pushed to its limit. Affordability is now the ceiling. Buyers are not choosing not to purchase because they do not want a new car. They are choosing not to purchase because the math no longer works. And when affordability tightens at this scale, demand does not gradually soften. It cracks. The wall is real, and we are watching the first buyers hit it in real time. While that pressure builds on the demand side, something equally important is happening on the supply side. Dealer inventory is quietly building again. Days of supply are rising across multiple segments. Production has continued at a pace that is beginning to outrun retail velocity, and the result is lots that are filling back up in ways that were unthinkable 18 months ago. This matters because inventory levels are a direct measure of pricing power. When supply is constrained, dealers hold price. When supply builds, pricing power erodes. Reduced pricing power compresses margins. Margin compression eventually triggers production adjustments, and production adjustments ripple through the entire manufacturing ecosystem. The inventory signal alone is not a crisis, but it is an early fracture indicator, and it is moving in the wrong direction. The used car market is confirming the same story. Used prices surged abnormally during the shortage years, and that surge created a false floor under trade-in values that is now giving way. Auction prices are cooling. Trade-in values are slipping. Residual value forecasts are being adjusted downward by lenders who cannot afford to be wrong. And when used car prices fall, The downstream consequences are significant. Trade equity shrinks, negative equity rises. Buyers who plan to upgrade find themselves underwater on their current vehicle, which means they delay the new purchase. That delay reduces new car sales velocity, which increases new car inventory, which puts further pressure on pricing. The crack widens on its own once it starts. The loan picture is where the structural stress becomes most visible. Delinquency rates on auto loans are rising. The combination of extended loan terms, higher balances, and softening asset values is creating a pressure dynamic that the industry has seen before. When loan balances remain elevated and the asset securing the loan loses value, the borrower's position deteriorates rapidly. Subprime exposure in the auto loan market has increased. The percentage of consumers carrying loans longer than 72 months has reached levels that create real vulnerability when economic conditions shift. This is the turning point pattern. Individual delinquencies are always present in any credit market. But when delinquency trends move directionally upward across multiple lender categories simultaneously, you are no longer looking at individual financial stress. You are looking at systemic pressure building in the foundation. One of the clearest signals that demand is weakening is the return of manufacturer incentives. For nearly 2 years, incentives effectively disappeared. Manufacturers did not need to discount a market where supply was below demand. Cash rebates vanished. 0% financing offers went away. Dealers did not negotiate. They did not have to. Now that is changing. Cash rebates are returning. Low APR promotions are reappearing on manufacturer websites. Dealer discounts are quietly expanding, not loudly advertised, but present for buyers who know to ask. This is not generosity. Manufacturers do not discount strong markets. They protect them. When incentives return, it is a direct admission that demand needs to be stimulated, and stimulation is only necessary when organic demand is insufficient to clear inventory at current pricing. The electric vehicle segment is adding a separate layer of instability to an already complicated picture. EV pricing has been volatile. Federal tax credit eligibility has created confusion that paralyzes buying decisions. Used electric vehicle depreciation has shocked early adopters who expected the asset to hold value similarly to combustion vehicles and discovered it does not. Consumer hesitation around EVs is real and measurable. When buyers hesitate, inventory builds. When inventory builds in a segment that manufacturers have committed enormous capital to, pricing pressure follows. And pricing pressure in EVs creates a perception problem for the broader market, because buyers watching EV values collapse begin asking harder questions about vehicle value retention across all segments. The luxury market deserves specific attention because it functions as a leading indicator. Luxury buyers are the first to feel credit tightening. High monthly payments on premium vehicles are the first to become discretionary. Leasing residual values in the luxury segment are being recalibrated downward by captive finance arms that are protecting their balance sheets. Fleet orders from corporate accounts are being reduced. When discretionary spending softens in the luxury tier, it historically precedes broader economic caution by several months. The luxury segment is not just an isolated story. It is telling us something about where consumer confidence is heading in the wider market. Dealers themselves are under mounting operational pressure. Floor plan financing costs have risen significantly as interest rates increased. Dealers borrow to stock inventory, and the cost of carrying that inventory has increased materially. At the same time, inventory is aging faster as retail velocity slows, which forces discounting to clear units before carrying costs compound further. Discounting compresses profit per unit. Profit compression creates financial strain at the dealership level. And strained dealers are vulnerable dealers. Consolidation pressure in the dealer network is increasing. The small and mid-sized operators who survived the shortage years on exceptional margins are now facing a normalization that some will not absorb. It is worth putting this moment in historical context because patterns repeat. The 2008 automotive collapse was primarily credit-driven. Lending standards had become dangerously loose, and when credit froze, demand evaporated overnight. What is building today is different in its origin, but shares structural similarities in its trajectory. Overextended buyers, long loan terms, asset value recalibration on assets purchased at peak pricing. The differences are real. Lending standards today are generally tighter than 2008. Household balance sheets, for now, show more resilience. But cracks follow patterns regardless of their cause. And the pattern we are watching develop rhymes with prior corrections in ways that should not be dismissed. The macroeconomic implications extend well beyond car sales. The automotive sector is a core economic engine. Manufacturing employment, steel and aluminum demand, transportation infrastructure, finance arms, insurance markets, all of them move with automotive health. If the car market contracts meaningfully, the GDP impact is not theoretical. It is historical fact. Auto weakness has preceded or deepened every significant economic downturn in the modern era. What happens in dealership lots and auction houses does not stay there. 3 scenarios are plausible from this point. The first is controlled normalization. Prices soften gradually. Inventory stabilizes at healthy levels. Manufacturers manage production proactively, and the market resets to a sustainable equilibrium without a hard correction. The second scenario is an aggressive discount cycle. Incentives escalate, margin compression becomes severe. Some brands and dealers sustain real damage, but the market avoids a systemic breakdown. The third scenario is a broader correction. Negative equity spikes. Demand freezes as buyers wait for lower prices. Supply overwhelms retail capacity, and the self-reinforcing cycle of declining confidence accelerates the downturn. Which path unfolds depends on Federal Reserve policy, employment strength, and whether consumer credit health holds through the adjustment period. For anyone navigating this market right now, the practical implications are clear. Monitor days of supply in the segment you are considering. Dealers with high inventory days are negotiable whether they advertise it or not. Evaluate total cost of ownership, including insurance, not just the monthly payment. Avoid loan terms beyond 60 months if you can structure it. And if depreciation begins accelerating in your target segment, waiting is not weakness, it is strategy. The buyer who purchases at the bottom of a correction cycle when inventory is high and incentives are maximum will always outperform the buyer who moved at peak pricing with maximum loan exposure. Markets do not collapse overnight. They fracture quietly. Inventory builds quietly. Incentives creep back quietly. Delinquencies rise quietly. Until one day the shift is obvious to everyone. And by then the people who saw the early signals have already made their decisions. The car market is not crashing today, but it is cracking. The fracture lines are visible in the data, in the loan performance reports, in the auction results, and in the quiet return of discounts that were gone for 2 years. Cracks, if ignored, widen. And widening cracks in any structure eventually becomes something you can no longer ignore. Stay informed. In shifting markets, awareness is not just useful, it is leverage.